Welcome back. The Federal Reserve, as expected, left the benchmark interest rate unchanged. The central bank ended 2025, you may remember, with 3 consecutive rate cuts. Mortgage rates have ticked down as a result. I discuss this and a little bit more with CBS News business analyst Jill Schlesinger. Jill, there's all this build-up to a Fed rate day, so I guess it's obligatory. Give me your 30-second takedown.
So boring. Oh, my God. I think they were probably filling out their Super Bowl boxes. So obviously, this was a non-event. Most of the world expected the Fed to take a pause here. And, look, the reality is they really shouldn't do anything because, as Jerome Powell said, the labor market is firming up, so it's not getting worse. And the inflation rate and inflation overall, prices overall, remain higher than the Fed would like. So they're kind of waiting for a new direction. And remember, before you say, oh, we really want the Fed to cut rates, when they cut rates, one of the big problems that they are worried about if they cut too much is they juice up the economy and then inflation reaccelerates. We know that tax refunds are going to be bigger this year. That fiscal stimulus is going to juice up prices. So they don't want to add to that. So I think the Fed is being very careful here.
You take a 360 view of all economic data, and I love you for that, Jill. So I want to ask you, we have stock markets creating record highs pretty routinely, and yet we had a consumer sentiment survey at a 12-year low. What explains or accounts for that divergence?
I'm sure you've heard this term, this K-shaped economy, right? And you have the long arm of the K, and you've got 2 different pieces. One part is going up, one part is going down. And, think about this in 2 ways. It's sort of like a world of haves and have-nots. For consumers, people who are the top 20% of earners. So we're talking about households, they make more than $175,000 or $200,000 a year. They own their homes. They've got some money in their retirement accounts. They are spending money, and those consumers are propelling growth. Everyone else is contending with these high levels of prices that have accumulated over the last 5-some years. And when you look at companies, it's the same thing. There are haves, there are have-nots. There are companies that are exposed to AI. There are companies that can cut headcount and make their earnings look better. And there are other companies that are struggling. The small businesses, the small business optimism index is actually not at a great level. So what we're really contending with as investors is trying to make sense of if a whole bunch of people and a whole bunch of companies feel rotten, why are stocks going up? For a very simple reason. The companies that are doing well are making money. And a stock market investment is a bet on future earnings. So, listen, I know that a ton of this is AI spending, but there are other companies that are doing well. I think that what's really important here is you don't have to pick the top and the bottom of the market. I'm going to be like the boring certified financial planner right now. Stick to your diversified portfolio. Don't go crazy.
CBS News business analyst Jill Schlesinger. Always a pleasure, Jill. Thank you so much.
Thank you.